Very good morning, friends. So I hope you are all doing well. And I guess you made a revision also what we covered yesterday. Well, I think we are on the last leg of consolidation, and I've got two main agendas for the day. One is we need to discuss the concept of chain holding, how the consolidation is done in terms of chain holding. And we've got another main agenda, and that is a change in the ownership interest. If there has been a further acquisition or there has been a disposal of shares, and it either results in the control continued or it results in the control being lost, how do we handle the situation? So I think first I'm going to start off the inputs with reference to chain holding, which is being asked, if I rightly remember, twice in the exams. And it's a very easy process, though it looks complicated. There is just one or two slight little complicated adjustments which we need to understand the logic. Why do we do those kind of adjustments? Rest, trust me, it's absolutely similar to what you have done. And the best part is you're not going to see any case of dividends as far as chain holdings are concerned. Okay, so I think let's begin the journey with you, and let's begin with the chain holding concept. So good morning once again to all of you. So I think let's begin the journey. So I'm going to explain a couple of concepts as far as chain holding is concerned, along with a practical illustration itself. So I'm carrying the two examination questions, with the help of which I will explain how the process of consolidation in a chain holding is done. So let me share the question first with you, and we'll see within the question itself how we'll do the consolidation process. So this is the question number 20, which came in November 18 examination question. It's a November 18 examination question. Question number 20 on the screen. So I think let's first read the question to you, and then we'll understand. The process of consolidation again would involve a total of 6 steps, what we have done earlier. So the concept would remain largely the same. It says prepare a consolidated balance sheet on 31st March 18 of a group of companies comprising of Usha, Nisha, and Sandhya. So we can see that we're given 3 balance sheets, and we need to consolidate all the group put together. And after this balance sheet, we are given, it says the summarized balance sheets on that date is given. So we are required to make a consolidated balance sheet on March 18, and the separate financials on the same date is given. Then moving further, we are also given in the additional information. Let me zoom it a bit further. We're also given further in the additional information that Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya. So we can see the chain that Usha has got shares in Nisha and Nisha has got shares in Sandhya, and all these holdings are acquired on 30th September 17. So balance sheet is required on March 18, and the date of acquisition is in the middle of the year, that is 30th September. So naturally it is a case of a consolidation later. And of course, in this case, there is a presence of the NCI as well, because we're not holding 100% stake. Then he says the business of all the companies are not seasonal in nature, and therefore we can assume that profits are earned evenly throughout the year. Now, whenever we are doing the analysis of equity, we always take the presumption that let's divide the increase in the time ratio, which indirectly presumes that we are indirectly trying to say that all the profits are earned uniformly throughout the year. And I think without saying anything, it is an implied assumption that profits are always earned uniformly throughout the year. So it's just clarified that, activities are not seasonal, and you can take the safe presumption. Then on 1st April 17, not on the date of acquisition, but at the beginning of the year, mind you. So we're given the status on 1st April. The balances in the books of Nisha and Sandhya is given. So we're given the position of reserves and the retained earnings. So the component of other equity in the balance sheet is defined. Then it says 5 lakh is included in the inventory figure of Nisha, and it is included, and it says which is being purchased from Sandhya at cost plus 25%. I think this is the first question where we're looking at the position of a stock sale between each other. So we need to see, is it upstream or downstream in nature? So we very clearly given that the inventory is included in Nisha and this was purchased from Sandhya. So Sandhya made a sale to Nisha. So we can say it's an upstream transaction. And the moment we know it's an upstream transaction, you need to take the effect in terms of analysis of equity. And of course, you need to adjust the stock in the balance sheet as well. Then it says the parent company adopted an accounting policy to measure the NCI at a fair value, which means that we're going to get a full goodwill. And if there is going to be any impairment, that needs to be split between the parent and the NCI if there is impairment. And then it says, assume that the market prices of Nisha and Sandhya are the same as the respective face value. So we need to consider that the market value and the face value of both the companies is equal. I guess you can ignore the point number 6 because I think that is something which is, more towards AS21. So I think we can ignore what is given in the point number 6. Let's not even read it, delete it from the question. Then it says analysis of profits and note to accounts should be a part of your answer. And this question came in November 18 for 16 marks. And it has also come in MTP in 2020 as well as 22. So pretty straightforward question, might look a little technical, but there's certain key points which we need to consider when we are doing a consolidation. So let's begin the journey and let's see step by step how we are going to tackle the case of a chain holding. I would advise just keep the question in front of you and we'll accordingly do this. I think this is also given in the study material as well. Otherwise, you can just open the November 18 examination question. Just keep it ready with you. So let's begin the journey. And I am now going to first of all start with my step number 1. So this is the November 18 examination question. So let's begin with first of all the step number 1 where we identify the date of acquisitions and the percentage in this case. Now let's be very careful. It says in the point number 1, Usha has got shares in Nisha and Nisha has got shares in Sandhya. So we're given that Usha has got shares in Nisha and Nisha has got shares in Sandhya. So we can clearly see the chain that Usha has got shares in Nisha and Nisha has got shares in Sandhya. Now let's see the percentages given. Usha, it says, has got 80% shares in Nisha. So Usha has got 80% stake. And Nisha has got 75% shares in Sandhya. So that comes to 75%. And that's it. Nothing else is given. And both these shares are acquired on 30th September 17. So my date of acquisition is 30th September 17. That is the date of acquisition. Now, trust me, earlier, there were no complications in terms of step number 1. Now, there is going to be a little agenda which you need to keep in mind when it is going to be a chain holding. I would advise during the course of step number 1, please identify the NCI in both the companies. Now, watch this analysis carefully. Ultimately, the company which will make the consolidated balance sheet is the top company. So we can say that Usha is going to consolidate Nisha as well as Sandhya. So he's going to consolidate the entire group companies itself. So everything has to be seen from the point of view of the top company. So we need to see that what is the effective holding of Usha in Sandhya. So the first thing what you're going to do is you're going to identify that what is the effective percentage which the top company has in the bottom company. because he has 80% stake in Nisha, and through Nisha, he's got a 75% stake in Sandhya. So we need to see what is the effective percentage which Usha has got in Sandhya, the top company is got in the bottom company. So we can say he has got 80% of 75%. This is, you can say, the effective percentage. So the first thing, what are you going to do in terms of the step number one is calculate what is, you need to calculate what is the effective percentage. So if I consider 80 into 75, I think this works out at 60%. We can say this is the effective percentage which Usha has got in terms of Sandhya. So on a very apparent level, it seems that the NCI in this company is 25, but it is not technically 25%. Because you will decide the status of the NCI based on the effective percentage. So we're going to say that if he's got 60% effectively, that means the NCI has got a 40%. I think let me put this process once again, because this is a crucial point in terms of step one. So as I said, when you start with the step number one, get the acquisition dates and the percentages, the first thing which you need to do in terms of chain holding is you need to consider the effective percentage of the top company in the bottom company. Because it is through the middle company, the top has got a stake in the bottom company. So get the percentages which is effective. So we can say that he's got 80% of 75%. His effective percentage is 60. So the NCI in this case is 40. So we can say NCI in terms of Nisha is 20%. So we can say if I'm looking at the NCI in terms of Nisha, it is undoubtedly 20%. But if you look at the NCI in terms of Sandhya, it is supposed to be 40% based on the calculations done. I hope the step number one is pretty clear. This is the only addition which you need to do in terms of the chain holding. So far, so good. Now, let's go to the next step, and that is the analysis of the equity. And trust me, we're going to do the analysis of equity exactly in the same manner as we did earlier. Now, this is a case where consolidation is being done at a later date. So we need to definitely go for a step number 2A as well as step number 2B. So let's go to the next step, and that is step number 2A. So now once you go to the step number 2A, we need to be a little more careful as well. I would say there are now two subsidiaries, because if you're consolidating the group companies, the middle company is also a subsidiary and the bottom company is also a subsidiary. Does this mean that I'm going to get now two set of calculations for two subsidiaries? Yes. So am I going to do two analysis of equity? Yes. Two NCIs? Yes. Two goodwill or bargain purchase calculations? Yes. So indirectly, it becomes a double the effort in terms of doing the question. But yes, since there are two subsidiaries, you now need to make two set of calculations. But of course, the process remains the same. So let's do one thing. Let's make the analysis of other equity. And in terms of analysis of other equity, let me split this, and we're going to do two separate analyses. So we're going to do two separate analyses of other equity. One is for the middle company, Nisha, and one is for the bottom company, that is Sandhya. So I think let's consider the analysis of Nisha, and let's consider the analysis of Sandhya, and we'll do it one by one independently without overlapping the information. So let me first create a columns for pre and post acquisitions as well. So let's take a column for particulars and a pre and a post acquisition. And same, we can take a column for the particulars and a pre and post acquisition. So we're definitely going to maintain the formatting of solving the question. Everything absolutely remains the same. So let's consider the column for the particulars, and this is pre-acquisition, and this is post-acquisition. And this is again particulars, and this is pre-acquisition, and this is post-acquisition. And let's define it in terms of the dates, what is pre and what is post-acquisition. So we can say this is pre-30th September 17, and anything from the date of acquisition till the balance sheet date, that is March 18, becomes post. So we can also say that out of the current year earnings, we can say 6 months is pre and 6 months is post. So this is again pre-30th September. And this is from 30th September till 31st March 18, that becomes post-acquisition. Now here again, your focus points remains the same, what we discussed yesterday, that we need to consider 3 focus points. Look at the balance sheet of the subsidiary, do the analysis of other equity, 1. Look at any fair value adjustments in the additional information, 2. And look at any stock reserves which are upstream in nature. So the moment you do the analysis, your focus point should be very clear. We're looking in terms of other equity, then fair value adjustments and stock reserves, if any. So let's concentrate on the balance sheet of Nisha and do the analysis. Now, if you go to the balance sheet of Nisha, we can see that there is a reserve and there is a retained earnings. So we need to do the analysis of reserves and the retained earnings. So let's consider the reserves. And as usual, let's consider a time scale. And let's put down the dates as well. So we can say the beginning of the year is 1st April 17. The end of the year is March 18. And the date of acquisition is 30th September. That is middle of the year, 30th September 17. Now let's pick up the data which is given in the balance sheet and the additional information. Now, if you look at the position of the reserves, we can see the reserves are appearing at the end of the year to the extent of 50 lakhs. And if you go to the additional information, we are given the status in point number 3, the reserves on 1st April 17. Mind you, it is not the position on date of acquisition, but it is the position at the beginning of the year. And that is given to me, it is 40 lakhs. So we can see the movement during the year is that there is an increase to the extent of 10 lakhs, which is a movement during the year. So I think we can easily identify that in this case, 40 lakhs is definitely pre-acquisition in nature, because this is the balance on 1st April earned in the pre-acquisition. And this increase of 10 lakhs, can I say comfortably, can be divided in the time ratio, because this is an increase during the year and the date of acquisition is in the middle of the year. So we can divide this in the time ratio. That means this will be 5 lakhs and this will be 5 lakhs. Now, a further caution. I would say when you're doing this analysis of equity, especially in the post-acquisition column, it would be a good exercise to create a separate column for reserve and also create a separate column for retained earnings, only for the post, not for the pre. The reason, you are going to add the share of holding in subsidiary post-acquisition earning. So let the reserves get added to reserve, let the retained earnings get added to the retained earnings. So it would be a good exercise to segregate the reserves and the retained earnings in the post-acquisition column. Do this in every question. When you're looking at the post-acquisition column, as many items of other equity, as many columns you should split, so that I can later add the reserves to the reserve and I can add the retained earnings to the retained earnings. That is one exercise. So I think reserves is taken care. Now let's go to the next item in the balance sheet, and that is retained earnings. Again, we're going to consider a time scale for this purpose. So let's consider a time scale and get the dates. So this is on 1st April 17 beginning, and this is 31st March 18, and in the middle of the year is the date of acquisition, 30th September. So let's again look at what is given in the balance sheet. So we can see the retained earnings in the balance sheet is appearing at 25 lakhs. This is the status at the balance sheet date. And if you go to the point number 3, we are given the retained earnings is appearing to the extent of 10 lakh. So we can see the movement during the year is 15 lakh. So the increase in the retained earnings is to the extent of 15 lakhs. So I think we can definitely do a similar exercise like reserve. 10 lakhs is the balance at the beginning of the year, so certainly pre-acquisition. And the increase of 15 lakhs will be divided in the time ratio that is 7.5. And remember to consider a separate column in the post-acquisition column. So you can notice that we've taken the reserves on a separate column and the retained earnings on a separate column because we want to do a line-by-line addition in terms of balance sheet. Right, friends, I hope I am pretty clear in terms of the analysis of the other equity appearing in the balance sheet. Now, let's see if there are any fair value adjustments given in the question. No, we are not given any fair value adjustments. And if there is any upstream transactions, we are given that there was a sale which Sandhya made. So when we're going to look at the analysis of Sandhya, we'll have to eliminate the unrealized earnings as well. That's it. So I think I can comfortably consider the pre and the post acquisition figures in terms of Nisha. So let's consider what is the sum total. And I think this is 40 plus 5 plus 17.5. This is coming to 62.5 lakhs. And this will be 5 lakhs separate. And this will be 7.5 lakhs separate in terms of reserve and in terms of retained earning. I don't think so. There has been any complication so far, except for getting the effective percentage and getting the NCI, which the top is got in the bottom company. Rest, I think, seems to be pretty simple and straight indeed. Okay. Now let's go to the analysis in terms of Sandhya, absolutely on a similar lines. So here again, we're going to look at the balance sheet of the company and we're going to first pick up the reserves. Let's consider the time scale again. And let's pick up the dates. This is 1st April 17 and this is 31st March 18. And the middle of the year, 30th September, is the date of acquisition. Let's look at the balance sheet of Sandhya, and Sandhya has got a reserves at the end, which is 40 lakhs. And let's look at the additional information. So we can see in point number 3, the reserves at the beginning of the year is supposed to be 30 lakhs. So clearly we can see a movement that there is an increase to the extent of 10 lakhs during the year. I guess the analysis is again straight. So whatever is the balance at the beginning of the year is undoubtedly pre, and the increase will be divided in a time ratio. And when you're dividing it in a time ratio, create a separate column for reserves and create a separate column for retained earnings for a line-to-line addition. Okay, reserves is done. Next item in the balance sheet is supposed to be retained earnings. So here again, we're going to consider a time scale. Remember, if you're going to make a time scale, your life is going to be quite simple because it'll give you a complete control in terms of deciding that this is the position on acquisition date or at the beginning of the year. So accordingly, the increase is in a time ratio or post acquisition, whatever. So here again, we've got the balance at the beginning, 1st April 17 and at the end, March 18. And the acquisition date is 30th September, middle of the year. Let's again pick up the information from the balance sheet. The retained earnings of Sandhya is given 30 lakhs at the end of the year. And in the additional information in point number 3, the retained earnings is appearing to the extent of 15 lakhs at the beginning of the year. So there has been an increase to the extent of 15 lakhs during the year. So here again, the same analysis follows. The balance of 15 lakhs at the beginning is pre, and the increase goes in the time ratio 7.5, and this goes in a separate column that is 7.5. I don't think so. I have done any complication so far. It's a simple, easy process in terms of analysis. So this takes care of the balance sheet figures of reserves and retained earnings. No fair value adjustments, but there is a stock reserve which is upstream in nature. So let's consider the stock reserve elimination as well, which we will eliminate out of the post-acquisition retained earnings. As far as the profit, which is unrealized, is concerned, it would be eliminated from the retained earnings column because that represents the P&L column. So we given in point number 4, it says 5 lakhs is included in the inventory and it was sold at cost plus 25%. Now, when we say cost plus 25%, it means 1/4 on cost and it means it is 1/5 on sale. So we're given the profit margin is cost plus 25, 1/4 on cost and 1/5 on sale. So if the inventory is including 5 lakh, so 1/5 of that comes to 1 lakh. So we need to eliminate this unrealized profits of 1 lakh from the post-acquisition column. And I think that's it. Nothing else is given. No fair value adjustments are given. So we get the position of pre and the post-acquisitions as well. So let's see the total. This is 35 and 22.5. This works out at 57.5. And this will be 5 lakhs separately and 6.5 lakhs separately. That takes care of the analysis of other equity for both the companies, middle as well as the bottom. I guess so far so good. I don't think so there would be any kind of complications coming to your mind so far. So that was pretty easy. Trust me, I've not done anything new in terms of the step number 2A. This is absolutely a similar exercise which you do. Okay, let me still see if any questions coming in so far. No, good. Okay, now we go on to the next step, and that is step number 2B. So now we go to the next step, and that is step number 2B, in which we need to calculate the net assets. We need to calculate the net assets on date of acquisition. So we need the net assets on the date of acquisition, of course, at a fair value. Now, in any case, fair value adjustments are not given. So we're going to take the total of the share capital and the pre-acquisition profits. So let's organize this as well. So let's do this for both the companies. We need it for both middle as well as the bottom company. So we need this for Nisha as well. And we need this for Sandhya as well. And we're going to consider this as a sum total of the equity share capital and the pre-acquisition profits. On that basis, we're going to get the net assets as well. And it's good to organize the data of both the companies together so that at least you save a lot of time. Otherwise, you keep doing a separate note for each one of them. Could be time consuming. So let's go to the balance sheet of Nisha, and we can see that the share capital is appearing to the extent of 200. And the share capital of Sandhya is appearing to the extent of 160. And we've already done the pre-acquisition figures. This is 62.5 and that is 57.5. So this is 62.5 and this is 57.5. All figures are in lakhs. So I think that gives me the status of the net assets on the date of acquisition. So this gives me the status of the net assets on acquisition date. So this works out at 217.5 and this works out at 262.5. This is the net assets on date of acquisition. My step number 2B is also done. Now comes the step number 3 and the step number 4. Now friends, I'm going to do something here which is going to be a new addition in terms of chain holding, and you will certainly ask me a question. Don't worry, I will first tell you what is to be done and then I will give you the logic as well. So don't get worried, because I'll tell you this is to be done and you say why it is to be done. So I'll first tell you that this is to be done. We'll understand the logic as well. So I think let's go to the next page and do the calculations on NCI as well as the goodwill. So step number 3 is on the calculation of NCI. So I'm looking at the calculations of the NCI, one hand, and I'm also going to look at the step number 4 simultaneously, and that is goodwill or a bargain purchase gain. Now be very careful as I do the calculations of NCI and goodwill, because I think the second key agenda, what you're going to confront in a chain holding is this particular part. So let me just organize the formats. And we're going to look at the NCI for the two companies, middle and bottom. And we're also going to look at the goodwill or bargain purchase gain for the middle as well as for the bottom. So let's first organize the formatting and then we'll take it further. So this is going to be Nisha and this is going to be Sandhya. So we've got two subsidiaries. So we're making two calculations, one for the middle company and one for the bottom company. So let's take a column for the particulars and for the particulars. Now, my advice in this particular case is when you're doing such a question, first organize the particulars column. Don't be in a haste and organize first of all the particulars column, and then we can, get the information. So when you're looking at NCI, we need to consider the NCI on date of acquisition, which is very clearly given in the question, is to be taken at a fair value. He's very clearly said that the accounting policy of the company is to consider the NCI at a fair value. And to this, you need to add the share in post-acquisition profits. To this, we need to add the share in the post-acquisition profits as well. And that's it. That's how the NCI will be done. And in terms of goodwill, you're going to consider the purchase consideration, to which you're going to add the NCI. And once you take the sum total of this, you're going to compare this with the net assets on the date of acquisition, of course, at a fair value. And with this, you're going to get the goodwill or the bargain purchase gain. So go stage by stage so that you don't go wrong. So at the first instance, organize the formatting. Just pick up the information in the particulars column. And then before you go further, let us see the percentages in terms of NCI and let us see the percentages in terms of the control. So we need to see everything from the point of view of the top company. So let's organize the data. So I'm going to first of all look at the step number 1 and see my percentages carefully. We can see Usha in Nisha is 80 and 20. So let's go to Nisha. So we can say that NCI is 20% and the parent company has got 80%. Get the percentages from the step number 1 that Usha has got 80 in Nisha and 20% NCI. Go back to the step number 1 and we can see that in terms of Nisha and Sandhya, it is 60-40, not 75-25. Not 75-25, we need 60-40. So let's go back and write down the percentage. So we can say it is 40% and it is supposed to be 60. You need to get the effective percentages in this case. You need to get the effective percentages in this case. So when you're putting this information, get it very clear. So I'm again putting the emphasis. First, organize the information in the particulars column and then get the effective percentages from the point of view of the top company, what the top has in middle, what the top has in the bottom, the effective percentages, both for the parent and the NCI. Now, watch this carefully as I make a calculations in terms of goodwill to begin with. Now, in terms of the goodwill calculations, let's go to the PC. I'm not doing NCI right now. I'm looking at the goodwill. Or maybe we can do NCI. It's not an issue. Okay, let's, I think, do NCI. Why disturb the order? Now, we're given in the point number 5 of the additional information the company has got a policy of taking NCI at a fair value, and it says assume that the market price of the share is as good as the face value. So let's go to the balance sheet of Nisha. So we can see the share capital is supposed to be 200, and we can say 20% belongs to the NCI, that is 40. Because we are considering NCI at a fair value, and it says consider the market price and the face value to be equal. So I've taken the face value of the shares into 20%, that is NCI at a market price. Similarly, for Sandhya, it is 160 is the share capital, and you consider 40%, that comes to 64. So we've just taken the share capital at a face value, which is as good as market price, and we've taken the NCI percentages in that. Let me also ask myself a question. Can I afford to take this NCI? Can I afford to take this NCI from the step number 3? You tell me. Considering that the NCI is at a fair value, and even otherwise it's not at PASNA, there is no dividend information, can I safely pick up this NCI from the data which is there in step number 3? What do you say? I think let's get that input from your side. Can I pick up the NCI from step number 3 for the goodwill calculations? Remember, it was only a caution when the NCI is at PASNA and there is a dividend information. In this case, NCI is at a fair value, even otherwise there is no dividends at all. So can I safely pick up this information from the step number 3 itself? And I think I didn't get any answer so far. So I think I need to answer that. Yes, I got the answer. Yes, you can. So we can easily pick up this information, 40 and 64 respectively. That's great. Okay, now let's go further. This is one thing. Let me complete the NCI. Now let's go to the post-acquisition earnings. And in terms of the post-acquisition earnings, be careful. There is a reserve and RE, and there is a reserve and RE. So we need to consider the post-acquisition for each one of them. So we can say in terms of Nisha, 5 lakh is reserve, 7.5 lakh is RE, and we need to consider a 20% stake in each one of them. So we need to consider a 20% stake. So this is the post-acquisition reserve into share, post-acquisition RE into share. Similarly, we can consider post-acquisition reserve into the share is 40, and post-acquisition reserve, that is 6.5, and into the share, that is 40%. So we're picking this information from the analysis of equity, the post-acquisition reserves and RE into the respective percentages. Let's get this. So this, I think, works out at 1 plus 7.5 into 20%, 1.5. And this will be 5 into 40% 2. And 6.5 into 40% is 2.6. So we can get the NCI. So this is going to be 42.5. And this is going to be 64 plus 4.6. That comes to 68.6. I guess so far so good, no complications so far. The only caution which you need to be careful on is you need to get the effective percentages so that you are able to organize the NCI and you're able to organize goodwill. My NCI calculation is not yet done. Now the next 10 minutes is going to be crucial because I'm going to do something and I'm going to explain the logic as well. So the next 10-15 minutes is going to be very crucial for the understanding. So give me a full attention at this stage. Now let me come back to the goodwill, though my NCI calculations is still pending, but let me first concentrate on the goodwill. Now let's see the investment in the balance sheet. The investment in the balance sheet in Usha is appearing at 170. The investment which is appearing in the balance sheet of Nisha is 140. Now, I will first tell you what is to be done. Don't get worried. The logic will also be given in detail. I cannot afford to take 140 out here. I cannot afford to take 140 out here. Let me explain. This 140 is what he paid for 75%. The middle company, please hear the words carefully. The middle company acquired in the bottom company a total of 75% shares. If I take you back on the step number one, just see the percentages again. The middle company acquired 75% shares and the investment appearing. And the investment appearing in the balance sheet is appearing at 140 lakhs. So this 140 lakhs is paid for 75%. But I am doing my calculations based on 80% of 75%. So since we are looking at an effective percentage, I cannot afford to take this 140 in the goodwill calculations. Since we are considering everything on a 60-40, so we need to consider that Usha is indirectly invested 80% of 75. So this 140 is that cost of 75%. We need to take only 80%. So we go back. And in this particular calculation, what do? We are going to consider 80% of this. We're going to consider 80% of this as a part of the goodwill calculation. So 140 into 80%, it comes to 112. So once more, you need to be very careful on a mathematical front. This entire calculation is from the point of view of the top company, there is Usha. If you look at from the Usha's point of view, he did not invest this entire 160. You can say that he has invested 80% of the shares in the middle and the middle invested 75%. So Usha has funded 80% of 75%. So this entire money paid by the company, which is middle, 80% of this is financed by the top company. So we can also say that indirectly that 20% is financed by the NCI. So what we're going to do in this particular case, the remaining 20%, which is not taken out here is going to be reduced from this place. So we did not get this. No worry, no worry. Right now, you just need to remember that you got to consider the effective percentage. So 80% goes in goodwill and the 20% is going to be a reduction from Nisha. I'll explain more in detail why this is so. So if I take 20%, it comes to 28. So this is one calculation which you need to do in terms of chain holding, that the investment to be considered is effective. So he's funded 80%, the rest 20% is reduced from the NCI of Nisha. No worry, I will give you more logic, but let me first finish the calculations. So this comes to a total of 174. So this works out at a total of, 210. And this works out at 112 plus 64, that is 176. And you can compare this with the net assets as well. And the net assets is 262.5. So 262.5 and 217.5. So in both the cases, we are getting a capital reserve. So let's see what is the capital reserve. So this comes to 52.5 and this comes to 41.5. So we can take the sum total of this and that would give us the total capital reserve, that is 94. Now let's also complete the NCI, then let's give you a little more detailed logic of why this reduction from the NCI is done. So let me see what is the NCI as well. That remains at 68.6 and this works out, I guess, at 14.5. So 68.6 and 14.5, if you take the sum total of this, it comes to 83.1. Right, so this is what you need to do in terms of the Goodwill and NCI. So right now, the focus is 80% of the investment is taken in goodwill and 20% of this becomes a reduction to the NCI. Why it is a reduction, we'll explain. I hope you've got the picture why we're taking 80%, because all the calculations are from the point of view of the top company. So we need to consider not the entire money paid, but 80% of that money is paid by the top company. So you need to consider 80% of this. So far, so good. I guess now let's understand the logic more in detail with you. Now, friends, I'm going to explain you in detail why this 28 got reduced out of the NCI. And for this purpose, I'm going to go out of this question. We'll come to the step number 5 and 6 later, but let's first understand why this is done. Let's understand the logic. Now, please hear me very carefully, because as I explain the logic, you need to make a walkthrough with me, understand the nitty-gritties of how the consolidation is done. Let's begin. Now, let's consider, for understanding perspective, this is the balance sheet of Nisha, and this is the balance sheet of Sandhya. Sorry, not Nisha, the top company. So we are given the balance sheet in terms of, yes, I would say, let's consider this is the balance sheet of the top company. So we can say the balance sheet of the top company, that is Usha, and this is the balance sheet of the middle company, that is Nisha. And let me also consider the third balance sheet as well. And this is the balance sheet of the bottom company, that is Sandhya. Okay, now watch this carefully, because if you get this analysis, trust me, you'll get the entire logic. There is an investment appearing in the balance sheet of Usha, and that investment is appearing at 170 lakhs. There is an investment appearing in the balance sheet of Nisha, and which is appearing to the extent of 140 lakhs. And I'm just keeping the balance sheet of Sandhya at the moment. And we're going to make a consolidated balance sheet as well. Now, please hear this very carefully as I make a walkthrough. If you remember my discussion, which I made when I started off the procedure of consolidation, and I gave you the 4 cases. When I started the accounting concept and I told you, let's understand the consolidation process, at that stage, I had given you something very important. And if you recall, I had given you that this investment gets eliminated. This investment gets eliminated. And what takes place is you aggregate all the assets and liabilities 100%. You represent a goodwill, that is 2, and you represent an NCI, that is 3. If you remember, I very clearly told you that investment gets replaced by, you can say, the share in net assets. It gets replaced by the share in net assets plus the goodwill. When you take 100% of the net assets and the NCI, you consider share in the net assets and the goodwill. So the investment gets replaced by the share in the net assets and the goodwill. That I've already given you mathematically as well, that in a consolidation process, the investment is removed and what comes in its place is 100% asset liability with an NCI. So effectively a share in the net assets and the goodwill, right? I guess you remember that. So that was the key issue. Now let's move further. Now, first of all, if you notice in terms of Usha, can I say, if you consider Usha's investment in Nisha, we never took any effective percentages, which means You took this entire 170 in a goodwill calculations. So you aggregated 100% of the assets liability, and you took this entire investment. You took this entire investment in the goodwill calculation. You took this entire investment in the goodwill calculation, and you took the remaining NCI as well. So in terms of Usha, in Nisha, there was no problem, because you took the entire investment in the calculation of the goodwill, aggregated all the assets, and reflected the NCI. Now, let's come to Sandhya. If you look at Sandhya, in this particular case, when you look at Sandhya, what did we do? Did I consider this entire investment in the goodwill calculation? No. Did I consider the entire investment in the goodwill calculation? No, I took only 80% of this. So I took in the goodwill calculation only 80% of 140. So we can say the remaining investment is still pending in the balance sheet. So the remaining 20% is still pending in the balance sheet. It has not been taken anywhere else. You took only 80% in the calculation of goodwill, so 20% is still pending on the asset side of the balance sheet. Please keep that in mind. You're going to aggregate all the assets and liabilities, and you took the NCI also out here. Now the problem is, what is the problem? If you look at the consolidated balance sheet, there is an NCI figure, and there is a 20% investment figure on the asset side. There is a NCI on the liability side of the balance sheet, and there is a 20% investment on the asset side of the balance sheet. And now let's understand, this 20% investment is made by whom? So we know it very carefully. If you look at the chain, Usha has got shares in Nisha, and Nisha has got shares in Sandhya. So we know that Usha has got 80% in Nisha, and Nisha has got 75% in Sandhya. Now please hear this carefully. We can say whatever money is invested by Nisha, whatever money, please hear the sentence very carefully, whatever money is invested by Nisha, you can say 80% comes from Usha, the parent, and 20% comes from the NCI of Nisha. Please hear this carefully. Because ultimately, Nisha is financed 80% by Usha and 20% by the NCI. His entire funding is 80% by Usha, and 20% of the financing is done by the NCI. Which means whatever money he invested in the company, 80% funded by Usha and 20% funded by the NCI of Nisha. So this 20% is supposed to be, you can say, funded by NCI of Nisha. You can say this 20% is funded by 20% of Nisha. So if this is going to appear on the asset side, that 20% I need to recover from NCI, and you're showing NCI which is payable. Why not set it off? Why not set it off? Because it is payable and it is recoverable from the same party. If it is recoverable and payable from the same party, so what we have done in this particular case, we have taken a reduction of the 20% from the NCI of Nisha. I guess you would like to explain this once more. If yes, do let me know. But I guess you would have got your apparent logics. Trust me, I think you would have got your apparent logics. Did you get the logics? You want me to put this once again and explain why the 20% set off in terms of NCI is being done? Or is this clear? Then we can go ahead. If you want to consolidate this once more, I'll do it. Okay, Sanish tells me, so yes, once again, please. Okay, I'll do that definitely again. Now, let's understand the nitty-gritties, because doing it is one thing, but understanding the logic is another thing. And trust me, you must understand the logic as well. Otherwise, it is very difficult to remember what is to be done. Okay, now let's come back. Let's start from the very beginning. and let's understand the criticality in terms of step number one. Let me go step by step. Don't copy anything. You already have the notes with you. Just sit down, relax, and hear every word carefully of what I'm saying. We need to understand one thing, that Usha has got 80% in Nisha has got 75% in Sandhya. Now, in this particular case, the consolidation will be done from the top company's perspective. So if you're going to do a consolidation in a chain holding from the top company's perspective, we need to understand that he has got 80% of 75% in Sandhya. If you look at the stake which a top company has in the bottom company, you need to consider what is the percentage. He invested 75% of the money in Sandhya, but 80% of the money comes from Usha. Please mind the words carefully. You need to understand the concept. So we can say that 80% of the money is funded by Usha and 20% of the money is funded by the NCI. So whatever investments the middle company will make is not fully financed by the top company. Please mind the words. Whatever investments the middle company will make is not fully financed by the top company. Only 80% of that money, is funded by the top company. The remaining 20% funded by outsiders. Please vouch me on what I said, because this is the most crucial point. So please vouch me. Did you understand this part? Did you understand this part, that any investments which Nisha makes, 80% gets financed by the parent, 20% financed by the NCI. Vouch me, friends, then I take it further. So I'm going to put it very clear. That Nisha made investment. To the extent of 140 lakhs. So can I clearly say that it is funded? It is funded 80% by Usha. Is that technically right to say? And 20% by NCI of Nisha. Is that technically correct to say? Please vouch me on this part. This is the most crucial part. So please vouch me very carefully that this company is financed 80% by Usha and 20% by outsiders, which is the NCI. Right? So I'm very clear on this, that this investment which Nisha made in Sandhya is financed 80% by Usha and 20% by the NCI of Nisha. Okay, I got a yes on that. That's great. And Shruti, you said, so why not NCI of Usha? No. The shareholding of Nisha, 80% is held by Usha. Who are those remaining 20%? Is it Usha? No. Somebody outsider, right? Whatever is the share capital of Nisha, 80% of that is held by Usha. The remaining 20% is there with some outsider, not connected to Usha. Correct? So in this particular case, we need to understand that his money is coming 80% by the parent and 20% is coming from the NCI. Therefore, I made it very clear that in this particular case, whatever investments he made in this company, the funding of this is 80% done by Usha and 20% is done by NCI. Okay, now please keep this in mind and let's take it further. So once we understood that 140 lakhs is funded 80% by Nisha, we said consolidation is done from Usha's perspective. So in this particular case, when I'm going to do a consolidation, you need to consider Usha as a base. The consolidation will be done what Usha has in Nisha, what Usha has effectively in Sandhya. And that is the reason we initially in step number one segregated these percentages. This is one thing which you need to keep in mind. The consolidation is to be done entirely from the point of view of the top company, which is Usha. Now let's go further. There is nothing technical in terms of step number 2A or step number 2B, but when I came to the goodwill and the NCI calculations, we need to understand something. So let's first understand why 80% here, and then let's understand why 20% reduction from here. Now, since we are looking at the calculations that Usha has got effectively what percentage in Sandhya, we're looking at the goodwill or the bargain purchase gain from the Usha's perspective. So Usha, the top company, would say that I did not finance 140 lakhs. I financed only 80% of this money. So I need to calculate a goodwill based on what I financed. So I'm going to calculate the NC, I'm going to calculate my goodwill based on what I financed. So I financed 60% of the money and 40% is financed by NCI. So he will say that when I'm going to calculate the goodwill, though it is a goodwill based on a fair value NCI and a full goodwill, but he would say that I'm financing only 60%, 40% financed by NCI. So the correct calculation of goodwill will come only when we consider what he effectively financed and what he effectively financed. Is that part clear? Am I clear with that part? That, we are considering why 80%? Because he says, I have financed effectively 60% of the money. And the remaining 40% of the money is not what I financed. So you need to consider 60% my financing, 40% financing by NCI. Great. So this is second part. Now let's see why a reduction coming on the other side. Now, the third phase, what you need to appreciate in this case is, when you look at a consolidation, what is done, this investment gets eliminated. This investment gets eliminated from the balance sheet. And if you recall what I gave you earlier, in a consolidation, investment is replaced by goodwill, 100% net assets and NCI. So in effect, this investment is replaced by the share in the net assets, 100% assets liability aggregated with NCI, and the goodwill comes into play. Now, there is no problem with reference to consolidation of Nisha. But the problem is the consolidation in terms of Sandhya. Now, watch this. In your goodwill calculations, you took only 80% of 140. We just did that. In the goodwill calculations, you took only 80% of 140 in the goodwill calculations. 20% was not taken. So if you mathematically remember, when I gave you the consolidation rules, I said investment will not appear in the balance sheet because it is taken in the goodwill calculations. I repeat. When I gave you the 5 rules of consolidation, I said the goodwill will not appear, the investment will not appear because it is taken in goodwill. But this time, only 80% went in the goodwill calculation. 20% did not go anywhere. If 20% did not go anywhere, will it still appear in the consolidated balance sheet? Technically, yes. I hope you got the picture. Since you are considering 80% of this investment in goodwill, the 20% which was not taken in goodwill should ideally continue to appear in the consolidated balance sheet. If that 20% continues in the balance sheet, now imagine you are going to show that 20% as an investment, which means I need to recover this 20% from whom? Please put the question to yourself. This 20% is to be recovered from whom? This money was invested by the NCI of Nisha, right? On one side, you are reflecting NCI payable to Nisha. And on the other side, you're reflecting money recoverable from the NCI of Nisha. Let me put it again. So you're going to reflect that this is what is payable to the NCI of Nisha and this is what is recoverable from the NCI of Nisha, because this investment was funded by them. Now, in a balance sheet, on one side you say payable to the NCI of Nisha and you say recoverable from the NCI of Nisha. This is like a common debtor creditor. The same party, you have a receivable and a payable. So why not net it off in terms of the balance sheet? So that's what we did. This NCI is reflected on the liability side, and this investment on the asset side is being set off, is being netted off. I hope, friends, I am now pretty clear on the logic that why we took 80% in terms of goodwill and why we took the 20% reduction of that investment from the NCI of Nisha, because the 20% was never taken in goodwill and I cannot allow it to show it in the balance sheet. Otherwise, my balance sheet will not agree. Right? I hope everybody's pretty clear. Do give me your input, friends. Are we clear? Don't worry. We're going to do another question also with you on this area so that we are absolutely crystal clear on the agenda. Right? So far, so good. Okay, I think Shruti said, sir, NCI is NCI, sir. How can we say NCI of Nisha? Only this point I'm not getting. Okay, let me explain that. Well, when you say NCI is NCI, you need to understand one thing. Let's I think give you a nomenclature so that we understand this better. Let's put it like this, so that you understand better, because NCI, the word indicates is nothing in life. Okay, let me explain and just vouch me on that particular part. Just vouch me on that part. I'm just going to take you back and let me say something. 80% of the capital of Usha, 80% of the capital of Nisha is given by Usha. 20% is given by, let's say, XYZ. Let's consider 20% is given by XYZ. So now let's put it like this. 20% of the shares of this company is with another company called XYZ. So can I say out of this 140 lakh, 80% financed by Usha, 20% by XYZ? Is that correct? Let's give the name NCI as a company XYZ. Now please watch this. Now please watch this part. Now in this particular case, as I gave you the inputs, you took 80% of the investment in the goodwill. The remaining 20%, is it invested by XYZ? Say yes or no. You need to first tell me that is that 20%, which is the investment, is that funded by XYZ, XYZ? Let's not call it as an NCI. Let's say that there is another company XYZ which holds a 20% shares in Nisha. So is that 20% investment funded by XYZ? And if you say a yes, then I think my next question is, what is this NCI payable to XYZ? What is that 20% investment recoverable from XYZ? Did you get your answer? So on one hand, you represent this is payable to XYZ. And on the other hand, this is recoverable from XYZ, which is nothing but the NCI. And in this particular case, you show it on the asset, you show it on the liability. So recoverable payable to the same party, and it makes sense that we net it off, we set it off. Okay, got it? Wonderful indeed. You're most welcome. Okay. So I think now let's do a little consolidations of the input in terms of what you need to track in terms of chain holding. So let's begin with the step number 1. Then we go to the step number 5 back again. So moral of the story, when you are considering a concept of a chain holding consolidation, what do you need to do? Get the effective percentages and get the NCI effective. This is the exercise number 1, which you need to do in step 1. Any inputs in step number 2A or 2B? No. There's nothing special in step number 2. The only thing is to be done in step 1. Then in step number 3, yes. You need to remember to reduce the money funded by the NCI. In step number 4, you need to remember to take only the effective percentage. So 3 focus points. Getting the effective percentage in step 1, in the NCI making a set off, in the goodwill calculations considering only the effective percentage. So far, so good. Now we are ready to go to step 5 as usual and the step 6 as usual. Okay, so let's, I think, take it further. So let me now add the step number 5. So here again, we need to consider the balance sheet of the equity. And when you go to consider the balance sheet of the equity, you've got calculations in terms of the share of the top in middle, the share of the top in the bottom, both. So let's do one thing. Let's get the other equity in terms of the consolidated balance sheet. Let's make an extract SOKI. Let's make a little extract SOKI as well, particulars. And I think we've got 2 columns, but I think we should take 3. So we've got 3 items in the balance, 2 items in the balance sheet. One is reserves, one is retained earnings. So one is reserves and one is retained earnings. And I think we can also take a capital reserve as well, the bargain purchase gain. So this is like making an extract SOKI. So in this particular case, let's consider the holding company's own retained earnings and the own reserves from the balance sheet as a base. And you've got a total of 4 items to be taken. Goodwill impairment, not there. Stock reserve downstream, not there. We just need a post-acquisition earnings. And that's it. Goodwill impairment is not there. Stock reserve, any downstream is not available. So we just need a post-acquisition and no dividend information. So if we go to the balance sheet of Usha, the reserves are appearing at 90 and the retained earnings is appearing at 80. This is the own reserves of the top company. And to this we add the share of, you can say, Usha in Nisha post-acquisition. We also need to consider the share of Usha, not Nisha, Usha in Sandhya effectively. So we need to consider everything from the top company's point of view, Usha in Nisha and Usha in Sandhya. So that's what we need to do. Let's go back on the analysis and see the post-acquisition figures. So I guess if you look at the post-acquisition figures in terms of step number 2A, this is 5 and 7.5 and that is 5 and 6.5. And I guess if you look at the percentages, I think it is 80 and 60. Okay, so let me come back on this. So we can say Usha in Nisha in terms of reserve, this was 5 lakhs into the share of the parent is 80. This is also 5 lakhs and the share of the parent is 60 effectively. And in terms of this, it is 7.5 into 80. And this was 6.5 into the effective percentage, 60. So be careful when you're considering the share in post-acquisition effective percentages in terms of this. Oh, I think I've taken it the other way around. Let me just rectify the figures. We have got different columns. I think, let me just watch it. So first, I think let's go to Usha in Nisha. So this is, I think, 5 into 80. And this is 7.5 into 80. And this is, I think, 5 into 60. And this is 6.5 into 60. I hope the figure is taken correct. So Usha in Sandhya is 60 and Usha in Nisha 80. I hope the calculations are correct. Okay, so with this, I think everything is done and we can take the bargain purchase gain as well. And my bargain purchase gain is appearing to the extent of 94. So let's put this as 94, that is bargain purchase gain. So we're going to get the total figures for the balance sheet point of view. So this is, I guess, 4, this is 3, and this is 80% 6. And this is 60% 3.9. So that's 94. And this is 97. And this is 86. And this 89.9. And let's add up all this up. So 97 plus 89.9 and 94. I think it works out at 280.9. That is the total equity. Wow. So that takes care of the status in this case. And now let's go further. So now we need to do the consolidated balance sheet absolutely in a usual manner. So now let's go to the step number 6. And when you're going to make a consolidated balance sheet, we need to be careful because you need to consolidate all the 3 companies, Usha, Nisha, Sandhya, because we're doing a group consolidation. So all the subsidiaries, that is both the subsidiaries and the parent, is going to be consolidated. Okay, so let's, I think, begin with the journey. And let's have a look in terms of the consolidated balance sheet, starting with the asset side. So wonderful question indeed. I think the energies goes in terms of, understanding the logic. If you just concentrate in terms of what is to be done, life is absolutely simple. The efforts gets concentrated mainly in terms of understanding, why are we doing that? So I think it took a time in terms of understanding that part. Okay, so on the asset side, we are given first of all the non-current assets. And in terms of the non-current assets, we have got tangible assets. We have got tangible assets, and that would be basically PPE. So no fair values are given, so we take the book value. So let's add up 160 plus 180, all three companies put together, and that is 150. So this gives me the figure of tangible assets. 160, 180, and 150, that is 490. Investments, of course, will not appear in the balance sheet, and there is no goodwill either. And then on the asset side, we've got current assets, and we've got cash and bank. So we've got cash and bank. So let's add up all these three. So this is going to be 114, 20, 20. So 114 plus 20 plus 20, and that makes it 154. Then next we are given the bill receivable. And in terms of the bill receivable, it is 36 plus 0 plus 15, 36 plus nil plus 15, that makes it 51. And then there is a trade receivable, but I think for a bill receivable, there is intercompany owings on the liability side. We can see that in terms of the bills payable, there is a money which is 3515. There is intercompany owing of 35 and 15. So that's on the liability side. So effectively eliminating the intercompany owing, the bill receivable appears at 1. Then there is a trade receivable, no intercompany owings. So in terms of the trade receivable, this is 130, 50, and 110. So this is the trade receivable. So 180 plus 110, that's 290. And then we're given the inventory where we need to consider the stock reserve as well. So there is inventory. And in terms of inventory, 11035, 11035, and there is 25, and there is a stock reserve to the extent of 1 lakh, which also needs to be eliminated from stock. So this works out at 169. And I guess that's it on the asset side. So that takes care of the asset side of the balance sheet. Let's see the total. So this is 490 plus 154 plus 291 and 169. I think it's coming to 1104. That is the total of the asset side. Okay, now let's begin with the liability side of the balance sheet as well. So let me now go on to the liability side, equity and liabilities. So we consider the equity and the liability side. So let's begin with the equity side, equity share capital, only for the parent company, which is the top company. That's 300. And then we can consider the other equity as well, that we've already taken in step 5. That's 280.9. That's 280.9. And least we forget, let's consider the NCI as well. And we can get the NCI. The NCI is 83.1. NCI is 83.1. So the equity elements are done. Then there are no non-current liabilities given. So no NCL. And we given the current liabilities as well. And for the current liabilities, we are given the trades payable. And this is 235 plus 115. And that's to the extent of 90. So 115 plus 90, that's it. No intercompany owings in this case. So that works out at 440. And as far as the bills payable is concerned, That's eliminated 15 plus 35 minus the intercompany owings, it becomes 0. Okay, I think that's it. Nothing else is given. So we can see is the balance sheet agreed or not. So 300 plus 280.9, 83.1 and 440. So this works out at 1104. Wow, the balance sheet is agreed on this. Wow. So I think it's taken us almost around 1 hour, 20 minutes doing that particular question. Looks scary, but that was more to understand the logic. But I think you've now fairly understood things. So before we go to the next question, I just want to do a small little inputs, which is going to be helpful to you at a later stage. Because, with so many inputs, it is very difficult to remember, what are the key considerations to be kept in mind. So let's do one thing. Let's, I think, give you the 3 focus points, what you need to keep in terms of chain holding. So moral of the story. You can say when you get a question on a chain holding, so what are the crucial points you need to keep in mind? And trust me, we've got 3 focus points. It's based on simply 3 focus points, the crucial things which you need to keep in mind when you are looking at a chain holding. Number 1. When you go to the step number 1, you need to calculate, you need to compute effective percentage. You need to calculate the effective percentage which the top company has in the bottom company. So this is one exercise you need to do in step number 1 that take care of the fact that you need to get the effective percentage. Then when you go to the step number 3, in terms of NCI, you need to reduce the amount funded by, the amount which is funded by NCI. So you need to make a reduction of the investment value, which is the amount funded by the NCI. And when you go to the step number 4, that is on the goodwill calculations, you need to consider the investment which is funded by top company. You need to consider the investment which is funded by the top company. And I think you'll easily remember, when you consider the funding by the top, automatically you remember that the remaining is to be reduced from the NCI. So these are the only 3 crucial points which I've explained with logic as well why we are doing so. So far, so good. I guess, friends, let's get your comfort zones on a chain holding concept now. I want you to give me your comfort zones on a scale of 10 on the concept of the chain holding. I know you may not be very comfortable, but I think a score of around 7, 8 seems to be quite good at this stage. Because once you go to practice and do this question by hand, you'll certainly go to get a very good hang in terms of things. Okay, that's pretty good. We're getting a score of 8.5 and 9. Wow, that's brilliant indeed. Super. Okay, so I think now what we can do, we can try another question with you. Let's not do the complete question maybe. Or maybe we can first start with something different. And then if the time permits, we can maybe come back to a little portion on chain holding. So I think since we've got that comfort zones, I think let's first focus on another area of discussions because that is a very interesting part. Let's, I think, go further. I'm now coming to another area of discussion in this particular standard. And that's grade 9. Wow, wonderful indeed. Now I'm coming to another area of discussion in the standard, which is a last focus as well. We have seen, if you remember, the control assessment. Rather, my journey, started in terms of Indes 110, where we did our discussions on the scope. And then we went on to the next area in terms of control assessment based on voting rights, based on decision-making rights. Then we went on to the consolidation process, where we saw the balance sheets and the income statement consolidations, including the chain holding. Now, the other area of focus is an area which is called changes in ownership interest. So we've got something what we call changes in ownership interest. This is called a changes in ownership interest. Now, let me tell you something plain point blank. My experience also tells me that sometime when you make the life of the people simple, they don't love it. Sometimes when you make their life simple, they don't trust you for that. How can things be so simple as that? So what I'm going to do, I'm going to first make your life simple, trust me, and we'll do a couple of questions on that area as well. But let's first understand the thought. When you say there is a change in the ownership interest, I would broadly divide my discussions into two elements. There may be a further acquisition or there may be a disposal resulting in a change in the percentage, but the control doesn't go. Mind the words carefully. Mind the words carefully. When you're looking at a company already has a control over the investee and you acquire more shares or you sell more shares, but the control is not lost. So one of the situation is that the control is not lost. So when I say the control is not lost, I would say there can be two permutations combination. It could be a case where it is a further acquisition. It could be a case where it is a further acquisition, or it could be a case which is a disposal. But even after disposal, the control continues. So when you see that the control is not lost, it could be, for example, a situation where you had an 80% stake, you acquired another 10% stake, and you got 90% stake. Or it could be a case of disposal. For example, you had a 80% stake and you sold, let us say, a 10% stake, and you still have a 70% stake with you. So there can be two situations. One is a case of further acquisition and one is a case of disposal. In both the cases, post the transaction, the control is still there. Now, the crucial question arises. If a company acquires more stake or if a company sells off a certain stake, are you going to change the goodwill? No. The goodwill identified earlier does not undergo a change. When there is a transaction which does not change the control, we only say that the two equity shareholders are transacting with each other. The majority and the minority, the parent and the NCI are dealing with each other. So in this particular case, the goodwill cannot undergo a change, because in this case, you can say earlier the NCI was 20 and now the NCI is 10. So the transaction is happening between the parent and the NCI. In this case, you can say 20% was the NCI and now it is 30. So the parent is dealing with the NCI. It's an equity transaction. So the focus you need to keep in mind that if the control is not diluted in the sense the control is not lost. In this particular case, no changes in goodwill. So in both the cases, when the control is not lost, no change in goodwill. There is going to be no change in terms of the goodwill computed. Your goodwill remains intact. So what do we do? Just change the NCI. So what we're going to do in this particular case, let me give you the entries. If you further acquire shares, the NCI goes down. So you need to debit the NCI because you need to decrease the NCI. And since you paid a money, you need to give a credit to the bank for the 10% stake acquired. So in this particular case, you debit the NCI because the NCI has gone down and you credit the bank. And of course, there will be a difference in this transaction. And since it is considered to be a transaction between equity shareholders, parent NCI never touch the P&L, it's going to be directly taken in equity. Like, for example, when you pay a dividend to the shareholders, it is never considered as an expense in the P&L. It is considered to be an appropriation and every movement takes place within SOKI. So in this particular case, any balancing figure is going to be taken directly in terms of equity, that is SOKI. And trust me, in this case, a reverse entry will happen. I am selling shares, so we will put the entry bank account debit for the 10% stake sold and the NCI has gone down. gone up. So there is an increase in the NCI. So give a credit to the NCI. And any balancing figure in this entry is again going to be taken in terms of equity because it is an equity transaction between the shareholder. So these are the only two possibilities which can arise once you say that the control is not lost. So look at the question carefully. See, is it a further acquisition or a disposal, and the control continues. So this is the entry to be done. In a further acquisition, NCI goes down, and in a disposal, NCI goes up. So bank to NCI, NCI to bank, and the balancing figure is taken to the equity. But the only concern now is how do we calculate the increase or the decrease in NCI? That we'll see. That we'll see in a question. Now, coming to the next agenda, and that is when the control is lost. The other case is that the control is lost. Now, if the control is lost, that becomes a very interesting situation because you are going to move out of the standard. Because if the control is lost, you are going to move out of the standard. Now the consolidation will not take place under 110. In this space, there can be a lot of permutation combinations. Number one, we can say it can be a case of a full disposal. It can be a case of a full disposal. It cannot be a case of further acquisition. It can only be a case of a full disposal, or it may be a case of what we call a partial disposal. So either there is a full disposal or there is a partial disposal. So let's see the permutation combinations which can arise. A full disposal, of course, means 100% is being sold. So from a control, you stand at 0. And the partial disposals could be, a lot of permutation combinations. Number one, it could be a case where you convert. It could be a case where you convert into an associate company. It could be a case where you convert into an associate from a subsidiary which had a control. You convert into an associate, a significant influence. Or you could convert into a passive investor. You could convert into a simple passive investor. A passive investor would mean that your stake goes down below 20. If you remember earlier, we said a significant influence means 20 or more than 20. A passive investment would mean below 20. So your disposal takes place that you convert into a associate, 110 to 28. Or it could be a situation where you convert into a passive investor, that is 110 to 109. And there is another interesting concept, and that is called a deemed disposal. That is called a concept of a deemed disposal, where you don't dispose. But there are transactions which occurs and it leads to a disposal. Now, trust me, whether it is a full or a partial disposal, I am now going to give you a simple entry with which you will easily calculate things. So I'm going to consider all the 4 cases with you in a single entry. Watch this. When I'm looking at any permutation combination, whether you're looking at a full disposal or you're looking at a partial disposal, converting into associate, passive investor, whatever. Remember the golden rule. And the golden rule is when a control came, you did Ind AS 103 acquisition entry. And if the control goes off, I am going to do a reversal of Ind AS 103 entry. So the examiner would ask you to calculate a profit or loss on disposal with reference to the consolidated financial statements. So what I'm going to do, when there is going to be a full or a partial disposal, I will reverse the entry. I will reverse the acquisition entry which we did in Ind AS 103. So whatever entry I gave you in terms of Ind AS 103, trust me, I'm going to reverse that. Maybe when you go to look at the study material, that kind of entry is not given in the question, but this is my creation, and believe me, it works, it rocks. So whatever be the case, I'm going to simply put a reverse acquisition entry. Now let's imagine what was the acquisition entry. Net assets debit goodwill debit, NCI credit, investment credit, and the PC is given a credit. Reverse it now. So I'm giving you a comprehensive entry which I'm going to pass. I will put the entry bank account debit. This is with the sale proceeds. This is with the sale proceeds on disposal of the investment. I will debit the investment account, and this is with the investment which is still retained. And this will be recorded at a fair value. So we will put a debit to the investment. This is whatever investment is retained, either associate or a passive investor. So whatever the case be, and we're going to record this at the fair value on the date of disposal. We're going to make a derecognition of the NCI. So we will debit the NCI because we want to go for a derecognition of the NCI because control is gone. And if the control is gone, the NCI needs a removal from the balance sheet of the company. Then in this particular case, the liabilities will be given a debit because this is again going to be derecognized. You are basically doing what? You are deconsolidating. You're basically doing a deconsolidation because whatever assets, liabilities aggregated, derecognize. So the assets is going to be given a credit. The assets is going to be given a credit, derecognize. The goodwill which is appearing in the books of accounts will also be given a credit. Trust me, this is the golden entry with which you will record any kind of permutation combination. The bank gets a debit for the disposal proceeds. The investment gets debit at the fair value of the investment retained. The NCI, the net assets, the goodwill, they're all getting derecognized, and there will be some balancing figure in this entry. And that balancing figure is going to be a gain or loss on disposal, and that's going to be taken in the P&L. So whatever balancing figure comes out here, this is going to be a gain or loss on disposal of the shares, and that will be taken in the profit and loss account. Done. Trust me. So you are only going to look at the question with the framework. Let me consolidate the picture. When you're going to see a question on the changes in the ownership interest, your focus needs to be very clear. Your focus needs to be clear. Is it resulting in the control being continued or is the control lost? If the control continues, just see that is it a further acquisition or a disposal. Accordingly, NCI debit or credit, bank debit or credit, simple. And whatever is the gain or loss is going to be taken directly in equity. That's it. If it is a case where the control is lost, you need to see whether it's a partial or a full disposal, converting into associate, converting into passive investment, deemed disposal. We'll see what is deemed disposal. It's a common entry you will pass in every case. You're going to consider the bank, which is with the proceeds, investment retained, derecognition of all the items, NCI, goodwill, and net assets, and the balancing figure gain or loss. Makes your life simple. But there is something more which we are also going to cover further in the question, and that is typically there is one more inputs which you need to keep in mind. If it is a case typically in terms of, let's say, moving from Ind AS 110 and moving to Ind AS 28, that is a case of an associate. If it is a case of Ind AS 110 to Ind AS 28, during the consolidation process, you might have given a credit to the P&L or you might have given a credit to the OCI. Because when you consider the consolidation of the income statement, you would have consolidated P&L, you would have consolidated OCI. So there may be an accumulated OCI balances which are there in the books of accounts due to consolidation. So the question arises when you are going to go to Ind AS 28, what do you do with this accumulated OCI? We will do a scrutiny of this accumulated OCI. And if you remember, something what we did similar in terms of business combination, where you did a scrutiny when it was a conversion of associate into a control, you made a scrutiny and started deciding, is it R or is it NR? So we're going to make a scrutiny and decide, is it no recycling or is it recycling? And accordingly, you're going to put that money either in terms of retained earnings or you're going to put that money in terms of P&L. So we'll have to decide if it is a no recycling, then it will be transferred in the retained earnings. If it is a recycling, that money needs to be put in the P&L because the relationship is gone and the investment is being de-recognized. And if the investment is being de-recognized, you need to transfer the accumulated OCI balances in terms of P&L or retained earnings, depending upon NR and R status. Don't worry. We'll be doing a practical question on that. There is a question which is given in the study material on that area. So I think the basic framework is created. We have been able to get the picture in terms of the control continues, bank NCI involvement, and the balancing figure equity. Changes, the control is gone, a single reversal entry of 103, and maybe we'll have to take care of the accumulated OCI. So we'll start doing the practical illustrations with you, but I think after the break. And okay, Yadu says, so thank you, you made it a job easy. That's great indeed. So we're going to do some practical questions with you on this area, I think after the break. Let's consider the practical questions. First, relax your mind. So it's almost 8:41, so 10 to 12 minutes break, friends, and I join you back after the break. Relax your minds. Welcome back, friends. So I hope you had a relaxation of mind. So a little changeover in terms of the next section, that is change in the ownership interest. I've already given you the concept. Now I think we'll do some practical questions with you. So let's do the exercise. So I'm going to take you to some questions on this. And Shankara was totally upset due to some personal reasons, but made up my mind not to miss your class. And after attending your class, I almost forgot my worries and started concentrating on the class and understood the questions really well. Feeling blessed on this morning. Thank you. Well, that means a lot, Shankara, for me. I think, first of all, I would, definitely want that whatever worries you've got, please, it gets subsided. And I guess, concentrating on the studies is nothing better. Getting knowledge is always better. So I really trust me that God be with you. And I think all your worries definitely get eliminated soon. Thank you very much indeed for that. That means a lot for me in the morning as well. That makes my day. Okay, so let's, I think, start with the inputs. And I have selected certain questions on the change in the ownership interest. Let's, I think, begin the journey. So based on different permutations, combinations, let's have a look at the different case studies. I guess good to go, or do I need to zoom it further? Maybe a little more. Okay, I think that seems to be good to go. Okay, I think that's good to go. So let's begin the journey. I'm now going to pick up the questions and we're going to solve these questions as well. First, we'll look at the case, whether it is a case of a control continues or a control lost, and accordingly we decide. It says in question number 11, where I've already given in the brackets, it's a further acquisition. So looking the brackets itself, we can see that there is no loss of control. Entity A acquired 60% of the entity B 2 years ago, and at that time the fair value was 10,000. The net assets with a fair value of 6,000, which for the purpose of this example is same as the book value. And goodwill of 2,400 was recorded. He's already given you how this goodwill was computed 2 years back. So we compared the purchase consideration and we took 60% of the net assets, because in this case, it seems that they've taken the NCI at a PUSNA. Now, that is also important. Now, let me tell you something. When we're going to do these questions and you're going to debit or credit the NCI, there is a one very crucial point which comes to the mind, and I think I'd like to draw your attention before I read the question further. When you consider the NCI at a fair value, it means indirectly the goodwill is full. And when you say the goodwill is full, you can say the NCI appears at the share in the net assets plus the goodwill. Indirectly, when I say that the NCI is taken at a fair value and you get the concept of full goodwill, what does this exactly mean? It means that the NCI is getting reflected equal to the share in the net assets plus the goodwill. But when you say that the NCI is computed at PUSNA, in those particular cases, it is a partial goodwill. What does this mean? That the NCI is carried in the balance sheet at equal to the share in the net assets without goodwill. Because the goodwill relating to the NCI doesn't appear in the consolidation, which means the NCI is appearing at the net assets and it is not including goodwill, just the net assets. Now, this is a very crucial point you need to keep in mind. Because in the entry, when you're going to debit the NCI or you're going to give a credit to the NCI, I'm talking of a case where the control continues. So if the control continues and you see that it's a further acquisition or it's a disposal and you debit or credit the NCI, in those particular cases, you need to be careful. Is the goodwill full? That means the NCI is taken at a fair value. Then the NCI's share will be calculated on the net assets plus the goodwill. But if your NCI is taken at Pasna, it means a partial goodwill, then NCI will be recorded at a share in the net assets without goodwill. I hope I am pretty clear on that particular agenda. So let's take it further. Now, in this, coming back to this question, let's see the status of the NCI. It says goodwill was 2400. It was a PC compared to the share in the net assets, which indirectly means that you've done the calculations based on NCI taken at Pasna. If that be the case, that means it is a case of a partial goodwill in this particular case. So when you're going to record the NCI will be taken at a share in the net assets without any goodwill. Then he says on 1st October X0, A acquires a further 20% interest. So from 60, it becomes 80, taking the holding to 80%. And at that time, the fair value of B is 20,000 and A pays 4,000 for a 20% interest. At the time of purchase, the fair value of the net assets is given and the carrying amount of the NCI is 4,000 on that date. We need the entries to record the transaction. Now, one thing is pretty clear. It's a movement of 60 to 80, which means there is a further acquisition and the control continues. So in this particular case, what I need to do, let's put an entry. What I need to do in this particular case, I just need to decrease the NCI. So you need to give a debit to the NCI and the money paid, the bank will be given a credit. The only call which we need to decide is what is the amount at which NCI will be given a debit. Now that's very simple. Your NCI on the date of further acquisition is 4,000 and that 4,000 represents that the NCI was 40% earlier. Because we had a 60% stake, so 40% was with the NCI. Now the NCI has become 20%. If the NCI has become from 40 to 20, it is simply half. And if it is simply half, then what I can do, I can simply reduce the NCI by 50%. That is 50% of 4,000 done. What is the amount I paid to acquire this interest is 4,000. We paid 4,000. So whatever is a balancing figure that is going to be debited to the equity. So the balancing figure is the loss, which is equity adjusted. As simple as that. So read the question carefully, look at the status. Is the control going to continue? And if the control continues, then in this particular case, you need to change the NCI, which is pro rata changed, the payment made for the further acquisition and the balancing figure equity. I guess I'm pretty clear with that. Let's go to the next one. Let's go to the question number 12 now. This is an opposite case where there is going to be a disposal not resulting in a loss of control. So it's the opposite of the question number 11. It says entity P sells 20% interest in a wholly owned subsidiary to outside investors for 100 lakhs in cash. The carrying value of the net assets is 300, including goodwill from the subsidiary's initial acquisition. Now, the question what comes to the mind is that in this case, NCI was taken at what value? There was no NCI earlier. We had a 100% stake in the company, which means that there was no NCI earlier. So which means now it's up to me to decide that am I going to consider the NCI at a PASNA or at a fair value? And I think if nothing is given, we should always consider a net assets plus the goodwill, consider the NCI based on a full goodwill. So in this particular case, if I look at the entry, I made a sale. So let me put it like this. Let's put the entry. So we can say in this particular case, we made a disposal. So the entry will be bank will be given a debit for the money received. And we need to create an NCI because the NCI is now created at 20%. So once we consider the money received, we sold the investment for 100 lakhs. And the net assets, including the goodwill, is 300 lakh. So if you consider 300 lakhs into 20% NCI, that works out at 60 lakhs. And whatever is the balancing figure in this particular case, that balancing figure will be adjusted to equity. So we give a credit to the equity to the extent of 40 lakhs. These were the two questions where there has been a disposal and a further acquisition, but the control continues. So we've just changed the NCI and the gain loss is taken in the equity. I hope so far so good. So this is one case which is done. Now let's go to the next one. I'm coming to the question number 13, where we're now going to see the case where the control is gone. So we're going to see the cases where the control is gone. Let's consider question number 13. This is a case where there is a loss of control 80 to 0. It's a full disposal. That's a case. It says a parent purchased 80% interest for 1,60,000 on 1st April when the fair value of the net assets is 175. And there is a goodwill of 20,000 which arose under the partial goodwill method, which means the NCI is taken again at Pasna because it is a partial goodwill. So in this particular case, we are clearly given that the NCI was recorded at a partial goodwill. An impairment of goodwill of 8,000 is taken to the consolidated statements, which means now the goodwill appearing in the books of accounts is only 12,000. It was identified to be 20 at the time of consolidation, but then 8,000 impairment, so left with 12. No other impairment charges have been recorded. The parent sold the investment for 2 lakhs and the book value of the net assets on the consolidation date is given, not including the goodwill. So I am given the net assets excluding the goodwill of 12. When the subsidiary met the criteria to be classified as held for sale, under 105, no write-down was done because the expected fair value less cost to sell is greater than the book value. The parent carried the investment in the subsidiary at cost as permitted under Ind AS 27, that is for the separate financials. We need to calculate the gain or loss on disposal in the parent separate and in the consolidated financials. Okay, now that is a good one. So what we need to do now, we need to reflect the gain or loss in the separate and in the consolidated financials both. So let me present the answer out here. So let's present the answer to the question number 13. So we're going to first of all look at the solution to the question number 13. And I want to get the status in terms of separate and in terms of consolidated financial. The entries which I gave you is with reference to consolidation. Now, watch this carefully. So let's consider the inputs with reference to the separate financials and with reference to the consolidated financials. Now, my advice, when you see in a question that there is a loss of control, you first put your entry and then we'll get the amounts. Get the generic entry which I gave you, a reversal of Ind AS 103, bank gets a debit. Investment retained, if any, gets a debit. NCI derecognized gets a debit. And you can say the net assets gets a credit and the goodwill is derecognized gets a credit. Get the basic entry and then we can fill up the figures. You need to record the money received on sale, the investment retained, if any, derecognition of goodwill, NCI, net assets. Now let's get back and we'll pick up the information one by one. It says the book value of the subsidiaries net assets on the consolidated balance sheet is 225, not including the goodwill. So the investments, the net assets is 2,25,000. And the goodwill is to the extent of 12. Now watch me carefully because this is a crucial point. We are very clearly given in the question the goodwill was partial, which means NCI was at Pasna. If the NCI was at Pasna, can I say the NCI would have been appearing as a percentage of the net assets excluding goodwill? If the NCI would have been at a fair value, the NCI would have been appearing at a share of net assets plus the goodwill. So when you're going to consider the NCI figure in these entry, you need to be conscious on the fact that whether NCI is at Pasna, then take a share in the net assets without goodwill. If the NCI is at a fair value, you need to take the share in the net assets plus the goodwill. So in this case, we are considering Pasna. So in this particular case, we know there was a 20% NCI because 80% was with the parent. So 20% of this would mean we can say 44,500 is the amount. 44 or I think it's 45. Let me just compute this. So out of 2,25,000, 20% belongs to the NCI. That's 45,000. Now it is a full disposal, so there is no investment which is retained. That becomes zero. Now let's see what is the money at which the investment is sold. The parent sold the investment for 2 lakh rupee. So we can record that this investment is sold at 2 lakh. Done. You can see how easy it'll become if you're going to put this entry. You're just going to record the entry with the money received, investment retained at a fair value, derecognition of these items, and the balancing figure is the gain or loss. So let's see the balancing figure. That is 245 minus 225 and minus 12. We are getting a balancing figure 8,000, and this is nothing but will be taken in the P&L. This is a gain on disposal of shares. But this entry is with reference to the consolidated financial statements. He's also asking you to calculate a gain or loss in the separate financials as well. And trust me, in this case, the calculation of gain or loss is purely based on what you used to do in the intermediate level accounting standard 13. Compare the cost versus the sale proceeds and we're done. So what we can do simply in this entry, bank gets a debit with the sale proceeds, that is 2 lakh. The investment gets a credit at the book value, which was the original cost of acquisition. He's very clear. He said the parent carried the investment in the subsidiary at a cost under Ind AS 27. So this is 160. So we know that this investment was appearing at 160. So we get a balancing figure 40,000 in this entry, which will be taken to the P&L. That is a gain on disposal. So we will get a different gain for the separate financials and a different gain for the consolidated financials. This is a case of a full disposal. So this was a permutation number 1. It was a case of 100% disposal. I hope, friends, I am pretty clear with the picture. You just need to be very careful looking at the data, deciding is a case of control continues or a lost. I guess so far so good. I hope everybody is pretty clear with the picture so far. Okay. Now let's go back and see more questions, team. Let's have a look at now the question number 14. So we've done 2 cases where the control continues. We've done 1 case where the control is gone and it is a full disposal. We'll do 3 more questions. 1 is passive investment, 1 is associate, and 1 is a deemed disposal, and then Jingalala, life is done. So let me come back on the question number 14. It says this is again a case of loss of control where we're going to convert to a passive investor from 100 to 10%. So similar entries will be done. A purchased 100% subsidiary, so there was no NCI. When the fair value of the net assets is 40 lakh, therefore the goodwill is simply 10 lakh. Comparing the purchase consideration 50 versus the net assets at a fair value, that gives me a goodwill, and undoubtedly it is a full goodwill. There is no NCI. A disposes of 90% interest at so and so and leaving a 10% investment on the date of disposal. The carrying value of the net assets excluding the goodwill is given. It doesn't make a difference to me because there was no NCI. So I am not bothered whether the NCI will be taken at net assets plus or minus goodwill, whatever. The fair value of the remaining investment is given, assumed for simplicity, pro rata of the fair value of the investment sold. You need to calculate the gain or loss in the separate and the consolidated financial statements on March X1. Let's do a similar kind of accounting in terms of question number 14 as well. So we're going to go to the question number 14, and this question number 14 is again on a case of control is gone, but it is a conversion into a passive investor. It is a partial disposal, and within partial disposal, it is a case of a passive investment. So let's organize the data in two parts. We're going to look at the separate and the consolidated financials to get the profit or loss. So get the generic entry and then organize the data. Once you put the entry, it's just getting the information and putting it there. So we need to put the entry bank account debit, investments retained if any debit, NCI derecognized gets a debit, and net assets gets a credit, and the goodwill gets a credit. And trust me, if you're going to do these questions with this way, trust me, it's very simple. If you look at the study material also, they've done some calculations where the entries are not given, but I have devised this technique that, if you put a reversal entry of 103, trust me, you always get the answer quick and fast. Okay, now let's go back to the data and let's fill up the figure. So let's go back to the question number 14 and let's see the input. So we're given the carrying value of the net assets excluding goodwill is 80 lakhs. So we know that the net assets is 80 lakhs. The goodwill is to the extent of 10 lakhs, and we know that there is no NCI in the question. Now let's go back and see what is the value at which the investment is sold. We sold the investment for 85.5 and the remaining value of the investment is 950. So 85.5 is the proceeds of the investment and the fair value of the investment retained is 9.5. As simple as that. So now you can see the balancing figure in this entry that becomes again a loss from consolidation. 85.5, 9.5, and this is 90. So we get a balancing figure which is 5 lakhs, and that will be taken in the P&L, represents the gain on disposal in consolidated financials. Isn't that pretty easy technique indeed? Not because I've created it, but I think it's a very easy way because you get concentrated in organizing information step by step. Now, if you look at the status in terms of the separate financials, the bank gets a debit at the sale proceeds. The investments will get a credit to the extent of the original cost of acquisition. And the investment was purchased at 50 lakhs initially. So this would be appearing at the original cost. And we're going to get a balancing figure, which is a gain on disposal and taken to the P&L. And that works out at 35.5 lakhs is the gain on disposal. Wow. So we've done two cases on a partial disposal, full 1 and conversion to passive investor 2. Let's go further. So now we're going to go to the question number 15, and I think this question is a good one indeed. Wow. So let's do one thing. I need to explain this question in a bit more detail. So I'm going to take you to the study material. I've also taken this question from the study material as well. And I'm going to explain the inputs to you through some things, because this is going to be slightly technical in nature. So let's have a look at this particular question. Yes, here it is. Let me zoom it and let's have a look. Okay, let's have a look out here. This is a question number 12 in the study mat. Oh, this has got, I think, slightly disturbed. Okay, maybe I think I can show you the question back from the other file. Let me just come back. So I guess I'll show you this from this file itself. Right, so let me just come back and show you from this file itself. Let's have a look at the question number 15. Now, this is one of the most interesting questions. I need to clear this out. Now, have a look at this question number 15. It's a very interesting question. You need to make a walkthrough with me very slowly and steadily on this. Now, watch this. In terms of question number 15, I am given a loss of control and it's a conversion into associate 90 to 20. Let's read. At the beginning of the current financial year, A has got a 90% equity interest in B, and during the financial year, A sells 70%. So from 90, it comes to 20, which is a significant influence. And this is sold at a total consideration of 50 lakhs, and consequently, it loses control over B. So he's given us only the stake which is being sold, and let's have a look further. This is also in the education material and is also given in the study material as well. If you ask me, I think this is one of the best questions on the changes in ownership interest, where the concept of accumulated OCI needs to be seen carefully. Let's have a look. It says at the date of disposal, the fair value of 20% interest retained is given. The carrying amount of the net assets in the consolidated financials on that date is 60 crores. So net assets is given and the fair value of the investment retained is given. Now, what's this carefully? This is what we need to understand carefully. Now, before I read, let me explain. When you did a consolidation, you did a consolidation of the balance sheet and the consolidation of the income statement under Ind AS 110. And in terms of the income statement, you would consolidate the P&L items and the OCI items line by line. So when you consolidate the items of P&L and OCI, so what happens that your accumulated, you can say your consolidated P&L is including an accumulated OCI balance as well. Now, since the relationship is the control is gone, you need to treat the accumulated balances in the OCI and take a conscious call. Is this recycling or no recycling? And accordingly, if it is no recycling, it enters the RE. And if it is a case of recycling, it will be taken to the P&L. So he's now going to tell us, what are the items in the accumulated balances in OCI, and you need to consciously decide whether it is R or NR. Let's begin. The aforementioned net assets includes investments in debt instruments classified as FPT OCI, and you've not done financial instrument standard. So let me tell you in advance. You'll see the logics later in financial instruments, but let me tell you in advance, when you're looking at a debt instruments at OCI, it is always with a recycling. It is always with a recycling. So this investment measured at FPT OCI is with a recycling effect. The related cumulative fair value gains in the OCI is 6 crores. So we need to transfer this money to the P&L. But only to the extent of the parent company's share, only to the extent, the percentage stands disposed. We'll see that. Then he says there is a net defined benefit liability, and this is also including a cumulative loss on account of remeasurement of net defined liability and is taken in OCI. This is by virtue of Ind AS 19. And if you remember, I think I want to put a question now at this particular stage. When you get a fair value gain or loss, or we can say a remeasurement gain or loss, and that amount is taken in OCI, can you tell me in terms of OCI, which tab of SOCI is it taken? That's a very crucial point, because you must have done Ind AS 19. So when you consider the remeasurement gain or loss, the actuarial gain or the actuarial loss, what we call as per Ind AS 19, the amount which is a remeasurement gain or loss is parked in the OCI. And where is it taken from the OCI? Does it go to the tab number 3 or the tab number 2 of the SOCI? I think I need your answer. So in the meantime, you give me the answer, then I'll come back. Let's go to point number C. It says investments in equity instruments, and that is 10 crores, for which an irrevocable option of recognizing changes in OCI is being availed. You're going to see in terms of Ind AS 109, once we cover financial instruments, that equity instruments is always NR, which is without a no recycling. A debt investments at FPT OCI is R, and equity investments at FPT OCI is supposed to be NR. So in this particular case, this amount goes in the P&L and this amount enters in the RE. Then it says net assets of a foreign operation and the related cumulative exchange gain arising on translation of the financial statements is given, and it is again recognized in OCI. And you've done this in terms of Ind AS 21, that when you translate the financial statements, the gain or loss is accumulated in OCI is supposed to be a case of R. So this, as per Ind AS 21, is a case of recycling. Okay, I didn't get a single answer on that. Why am I feeling that you don't know the answer and maybe therefore you did not give the answer? Is my perception correct? Let me know. Are you clear with the concept of, which standards we consider R and which standards we consider NR? Because it is very important that at the end of the day, once your FR is complete, you need to be crystal clear on the idea that what is taken in the OCI enters in R, NR, and where does it enter in the SOKI? Because in these kind of questions, the movement is to be taken to the PNL or the movement is taken in terms of the RE has to be very clear. Do give me your input, friends. I need to understand. Accordingly, I will tell you. Okay, so that part is still pending. And then it says in the consolidated financials, 90% of the cumulative gains in ACD. It doesn't mention B. It doesn't mention B. It says 90% of the gains mentioned in A, C, and D have been included in the separate components of equity, and 90% of the cumulative loss in B is included in the retained earnings as required by Ind AS Schedule 3. Wow. I still did not get an answer, friends. I need your inputs on that because I would give my explanations accordingly. Please tell me, are you aware of the concept of the actuarial gain or loss is parked in terms of SOKI under which tab? Say yes or no. How would I come to know? Otherwise, I'll presume you know it. And then it says further that carrying amount of NCI on the date of disposal is 6 crores. What is the accounting treatment on the loss of control in the consolidated financials of A? Okay, so I think we are given the inputs in terms of accumulated OCI balances, and with these movements, let's, I think, take it further. I still didn't get any input so far. Oh my God. Maybe you're sending the message, I'm not getting it. But I presume in the absence that you know where it is taken. So let me just quickly tell you. In terms of Ind AS 19, this balance is simply taken in the retained earnings itself. There is one exception in terms of, rather two exceptions, but one of the exceptions is that if there is any actuarial gain or loss under Ind AS 19, it is never taken to the tab number 3 of SOKI, but it is taken as a part of the retained earnings. So this amount doesn't have to be pushed again to the retained earnings or to the P&L. No subsequent accounting treatment would be required. So we can say, for point number A, you need to push the amount to the P&L. For point number C, you need to push the amount to RE. For point number D, you again need to push the amount in terms of P&L because it is recycling. So you can say your scrutiny will tell you 3 inputs. What is R, number 1? What is NR, number 2? And what is the portion which is not to be taken either to the RE or to be taken in terms of the P&L? And that is the exception in terms of point B. Okay, so let me now run the answers with you. Okay, I think I got the answers. So not able to recollect, and I am sorry, not able to recollect OCI. Okay, let me just ask you: are you aware that from the OCI it is accumulated in which components of SOKI, whether it is tab 1 or tab 2 or tab 3? Are you aware in terms of tab 1, tab 2, tab 3? You can say no. Don't worry. I'll give you those details, not today, but when we come to financial instruments, I will explain the concept of the tab 1, tab 2, tab 3 in detail. I'll give you the movements as well, that what is done. Maybe I can give you some basic inputs at this stage, but detailed inputs will come later. So are you aware of these 3 tabs or not? Just let me know. If yes, then it's okay. If no, let me at least give you some inputs so that we get started on this question. So let me, I think, quickly give you some inputs at this stage. Okay, let's come out of this question. And I think in the first instance, let's give you some input so that you can get started on your understanding. I'm not on consolidation. I am on the schedule 3, giving you a little inputs on the concept of SOKI. Watch me carefully. Okay, we got the answers. No, no worry, no worry. We're going to make you experts on that area more when we come to financial instruments. But for the time being, I'm just giving you only what we need for this particular question. So please watch me carefully. I am right now going to explain only a part of the schedule 3 for a better understanding. So please watch this very carefully. Now, let's consider that this is an extract in terms of the profit and loss. Let's say this is the income statement, and you've got a profit or loss for the period. You get a profit for the period, that is 1. And then you consider other comprehensive income, which is NR, and the concept of R, and we get a total comprehensive income. Let's consider this is SOKI, the statement of changes in equity. Let's consider this is the particulars. This is the tab number 1. This is the tab number 2. And this is the tab number 3. Now let's understand what is tab 1, tab 2, tab 3, because without this, your understanding on the previous question is going to be very superficial. Now let's have a look at this carefully. When you look at the tab 1, it is the, you can say, equity component of compound financial instruments. If you look at the format of SOKI, you're going to see that there is an equity component of a compound financial instruments, which you will learn when we come to Index 32. So no worries, right now I'm not concerned with tab 1. The tab 1 gets created only when a company issues a CFI, a compound financial instrument, which you will learn later. The tab number 2 is called the reserve and surplus, which has got various items like capital reserve, security premium, and most importantly, retained earnings. The tab number 2 is the reserve and surplus, which comprises of a lot of components like capital reserve, security premium, share premium, and there is a retained earnings. And the tab number 3 is whatever enters in the OCI, whether it is R or it is NR, enters in tab 3. So we can say that whatever is taken in the OCI section in the income statement enters the tab 3. Now, let's take some figures to understand this better. Let's say the profit for the period is, let's say, 6 lakh. Let's say the OCI, which is NRR, let's take it combined, is, let's say, to the extent of 4 lakh. So we get a total comprehensive income that is 10. Just taken some arbitrary figure. So let's say this is the profit for the period, and this is the OCI, and this is the total comprehensive income. Now, when you post this in terms of SOKI, you're going to write it like this: total comprehensive income. Now, this 6 lakh, which is the profit for the period, the P&L section is going to be taken as a part of the retained earnings, tab 2. Whatever enters in the profit for the period is taken in the tab number 2, RE, always. This amount is always taken in terms of the retained earnings, and that 4 lakh rupees is going to be taken in the tab number 3. Whatever is entered in the OCI RNR is taken in the tab number 3. So the profits comprise of, you can say, the profit and loss section and the OCI section. The profit and loss section enters in tab 2 RE, and the OCI section enters in terms of tab 3. Now, one thing which you need to be careful on, that when you say that this portion is comprising of R or NR, the portion which comprises of NR is going to be transferred to the retained earnings on derecognition of the investment. So whatever is the portion in the no recycling is simply shifted from the tab number 3 to tab number 2 on a derecognition of the investment. And the portion which relates to the recycling is taken to the profit and loss account in the year in which derecognition takes place. It is going to be taken in the P&L in the year in which derecognition takes place, and when it becomes a part of the profit of that year, it automatically enters the RE. I'll give you details later. In financial instruments, I'll give you detail later. So the NR portion is pushed to the RE directly without routing in P&L, and the recycling portion is put in the P&L, and from there it enters the RE. But there is one interesting case. There is one interesting case, and there is an exception. Rather, I would say there are two, but for the time being, let's consider one exception. There is one exception when item is taken in OCI, but it is taken in tab number 2 in RE and not tab 3. The exception is in terms of Ind AS 19, when you get an actuarial gain or when you get an actuarial loss, that actuarial gain or loss is taken to the tab 2 as a part of the retained earnings and not in terms of tab 3. Every item in the OCI goes in tab 3 always, with two exceptions. One of the exceptions I've given you is that the amount of actuarial gain or loss is taken in terms of the tab number 2. It's inserted in RE. If it is inserted in RE, do you think I need to decide that I should take it to the P&L or I should take it to the retained earnings? It is already in retained earnings. And if it is already in retained earnings, there is no need to push it back. There is no need to push it back in terms of P&L. I hope you got the picture. This is only to the extent of giving you understanding on this standard, though we'll discuss this in more detail when we come to the aspect on financial instruments. But I hope, friends, I am pretty clear so far. So moral of the story, what enters in the P&L goes in tab 2 RE. What enters in the OCI R&R generally goes to tab 3, but one exception in AS 19, which goes in RE. Am I clear? I guess. Right? I hope I'm pretty much clear. So far, so good. Now, let's take you back. Now, in this particular case, you can see that there is investments in debt instruments. This is by virtue of Index 109R. Then there is investment in equity instruments by virtue of Index 109 and R. Then there is a foreign currency translation reserve by virtue of Ind AS 21, it is R. And there is Ind AS 19 actuarial gain or loss, which neither is not to be seen as R or NR, because it was already taken in RE. Now see what is given in the additional information to get it started. It says 90% of the gains in ACD included in the separate components of equity. Separate component of equity means what? Separate component of equity means tab number 3. 90% of these gains is taken in the separate components of equity, tab number 3. And then it says 90% of the cumulative loss in B included in the retained earnings as required by Schedule 3. So that point number B, Index 19, is a part of the retained earnings. So he says ACD is in tab 3 and B is in tab 2 RE. Even if this was not given, we should know this. And then that's it. That's what is given. So now we need to see the entries for the sale of the investment and the treatment of these accumulated OCI balances as well. So I'm going to give you a run through of the answer, which is there in the study material, because I'll be able to explain it a little better. So let me just come back and give you some inputs on this. So let's have a look at this. Watch this carefully. This is the entry which we are going to look at. So this is the entry which we are going to look at in terms of how you are going to put the entry for the sale of investment. Now, if I just go back and I think organize the data, or maybe you can just keep the question in front of you. This is a question in the study material. So please keep the question in front of you, and I am just going to explain the entries in this case. So let me just open the question also with me, and then I'll start explaining this. So this is a question which is given in the study material as well. So let's, I think, read the inputs to you and keep vouching me on the figures. Now, we are very clearly given in the question at the very first part of the para, A sold 70% investment at 56 crores. So bank gets a debit. This is the same entry which is done as per Ind AS 103 reversal. Okay, then next we are given, so bank is recorded. As far as the NCI is concerned, at the end of the question, it says NCI on the date of disposal is 6 crores, derecognition of the NCI. Then as far as the fair value of the investments retained is concerned, it very clearly tells you that on the date of disposal, the fair value of the investment retained is 16 crores given in the question directly. So bank is taken a debit at the sale proceeds, NCI derecognized, investments retained is taken. And then the net assets is clearly given on the date of disposal, the net assets is 60 crores. So you would get a balancing figure, a gain on disposal, and this gain on disposal is going to be taken in the P&L. Simple. So this is the entry which we have been doing so far on the disposal of the investment 103 reversal entry. Now, moving forward. We need to consider 4 movements in the OCI. So let's have a look at the movements in the OCI. Now, please watch this carefully. There were 4 inputs given in the question regarding the OCI movements. Number 1, I was given the debt instruments which are classified as FPD OCI, and I said it is a case of recycling. If it is a case of recycling, the accumulated balances which is there in the OCI, we are going to shift that amount to the profit and loss account. So you can notice that we are given 6 crores was the accumulated OCI, and 90% belonging to the parent company is being taken and shifted in the profit and loss account. Why it has been shifted? Because it is a case of recycling. So on the derecognition of the investment, the accumulated OCI balances needs to be transferred in terms of P&L R. Before I go further, let's look at the other one, reclassification of the equity instruments. This is a case of NR. So you'll see in Ind AS 109, a debt instruments is always R, a equity instruments investment is always NR. NR means you just need to shift it from tab 3 to tab 2, retained earnings. So whatever is the accumulated balances, 4 crores into 90%, you can see is shifted in terms of retained earnings. This is P&L impact, and this is retained earnings. This is shifting the amounts from tab number 3 to the tab number 2 on account of NR. And this is reclassifying the amount to the P&L. Then there was another case before we come to the Ind AS 1921, the FCTR balance, the foreign currency translation reserve, that is FCTR. This is the balance which is there in terms of Ind AS 21, which is again a case of R. It is again a case of recycling, and when it is a case of recycling, you need to push that amount back to the P&L. So whatever is the accumulated balances, 8 crores into the parent share, 90% is taken to the P&L. So we have taken this 7.2 in terms of the profit and loss account again. So you can see accumulated OCI balances of R is taken to the P&L, NR is taken to the retained earnings, simply shifting tab 3 to tab 2. The only portion left over is the Ind AS 19 portion, and in this particular case, what we have done, the amount of gain or loss, actual gain or loss, in this particular case, the entry is done, but I would say practically no entry is done, because in this particular case, it is already in RE. It is already a part of the RE. It is already in tab number 2. So I don't need to do practically anything at this stage, because it is already a part. So I would say technically no entry is required to be done. Okay, so there is a moral of the story. There is a moral of the story which I want to give you at this end, and I think you'll definitely love that as a part of the note. So hear me carefully. Let me just consolidate the picture and tell you something more in this particular case. Which means if you look at this particular question, I think let me just go back to the area of discussions, or maybe I can put it here. Maybe we can put it here only. So what is important is that if I make a small note, so we can say one thing, that when you are typically moving from Ind AS 28 to Ind AS 110, mind you, this I've already covered in 103. This I've already covered in 103 when it was a case of a step acquisition. So we covered this in terms of Ind AS 103. So this was covered in 103. So I covered this area in terms of Ind AS 103 when it was a movement from a significant influence to 110. And if you recall, at that stage also, I did a question with you and I told you that you need to do a scrutiny. You need to do a scrutiny of the accumulated balance in OCI. And if you remember, at that stage also, we did the same thing, that whether it is NR or it is R. This is what we did in Ind AS 103. A case of step acquisition where a movement in the accumulated OCI was scrutinized. If it was NR, it was transferred to retained earnings. Do you remember the question which we did in Ind AS 103? When I explained the concept of purchase considerations and there was a case of a step acquisitions. And if it was a case of RE, it was transferred to the profit and loss account. It was transferred to the profit and loss account at that stage. And trust me, there can also be an amount which is already in RE. There is an amount which is already in retained earnings. In this case, you need to do nothing. Though we did not see this portion at that stage. Because we can say what is accumulated in OCI is either tab 3 R or it is tab 3 NR or it is tab 2 RE. If it is tab 3 NR RE, tab 3 R, then PNL, and if it is tab 2 already, nothing. So today what we have done in this particular case, we've done an opposite case, that we are saying that we're moving from Ind AS 110 and we're moving to Ind AS 28. This is what we're doing today. So this is a case of a disposal, what we are covering under Ind AS 110. So this is covered now. This is covered in Ind AS 110, the opposite case which is there. And trust me, a similar concept is coming out here. So we can say this concept is 100% the same. You need to apply a 100% similar concept here as well. That means we made a scrutiny of that accumulated OCI. What is R is taken in the PNL, what is NR is taken in the RE, and what is already in the RE is not touched. And the only exception is Ind AS 19. So I will give you a complete list of those items also when we come to the financial instruments, that which items enter the OCI. But let me tell you one thing very frank, friends, at this stage. So let me tell you one thing very frank, that there is Ind AS 16 and there is Ind AS 38. Due to revaluation model, you create an OCI which is NR. That is one. You have already covered. Then there is a concept in terms of Ind AS 21. There is a concept in terms of Ind AS 21 where you create an FCTR, foreign currency translation reserve, which is OCIR. So this is also done. So one OCI concept you covered in 16 and 38, that is NR. One you covered in terms of the Ind AS 21, that is supposed to be R. And apart from this, you are going to cover the concept in terms of Ind AS 109. And let me tell you in advance that if you've got equity investments, it is supposed to be OCI NR. And if it is supposed to be a debt investments, which you will see later, is always a case of OCI R. And And the only other item which gets created is on account of Ind AS 19. And in terms of Ind AS 19, the actual gain or loss is taken in the OCI, but that is taken directly in retained earnings. Trust me, this is a comprehensive list of all items which arise in OCI. I will give you more explanations when I come to the financial instruments, but this 1, this 2, this 3, and this 4. There is no fifth item for your level in the examination which enters in the OCI. It's either 1638, or it is 109, or it is 21, or it is 19. Life done. Jiggalala. So this is something which we will learn later on 109. At that stage, I will do a conceptual understanding further at that stage. But I hope this helps. Okay, so this is good and clear. Wonderful indeed. Now, let's go further. This question is done. So let me come back to the assignment, and we did question number 15 with you. So I did the question number 15 with you, and let's come back further. So question number 15 is done. Okay, there is another question on the concept of a deemed disposal, I guess. No, I have not taken that question, maybe. No, there is nothing which is further left. Okay, so far so good. So moral of the story. Now, before we go further, let's get the moral of the story. Finally, we've come to almost the end of the consolidation. But before I end, a little just quick recap of the major agendas, what you need to revise in this particular standard. Okay, but consolidation is not over, because we'll be having another 3 classes in terms of the leftover portions on consolidation. One is Ind AS 111, one is Ind AS 28 and 27. 27 is should be quite simple. For the examination point of view, not much inputs to be done. I think hardly been touched in the examination. So we need a little more inputs in 111 and 28. Now, before we end the journey out here, I would just like to take you to a quick inputs in terms of what you've learned under this standard. I went very systematic, and you need to now do a consolidated revisions of all what I have covered in the standard. I started in a very systematic manner on this particular Ind AS 110. If you remember, my journey started with the understanding the scope of the standard, giving you the areas in terms of exceptions and exemptions. Giving you the area of exceptions and exemptions. And in this particular area, I gave you the parameter of 4 conditions. And I gave you the parameter of a 3-step model, which was focusing completely in terms of the para number 4A and in terms of the para number 4B. We devoted almost an entire class on this particular area, giving you the focus in terms of the scope. Once we did with this particular area, we came to the next discussion, and our focus was in terms of doing a control assessment. Our input was in terms of doing a control assessment. And in terms of control assessments, I had given you 2 inputs. One is if your control assessment is based on voting rights, and if your control assessment is based on decision-making rights, DMR. And in this particular case, I covered out here again a 3-step model. And in this particular case also, we covered the same 3-step model, but the way of looking at things was slightly different. Here we were looking at the concept of, the DMR and the removal rights and the variable exposure in terms of remuneration and other stakes. And we did the questions on control assessment. But in both the cases, there was a little different assessment which was done. So we spent a good time on the control assessment. Almost, I would say we did almost like 2 separate classes, one on voting rights and one is on the decision-making rights. Then I went further and I gave you the consolidation technique. I gave you a consolidation technique, the consolidation procedure, and in terms of the consolidation technique, I basically gave you a 6-step model. I gave you a 6-step model which you need to apply. And in terms of the 6-step model, we did the intricacies of what are the focus points under each part. And I gave you the rules also in terms of the step number 6. What kind of rules do you need to keep in mind? Here we saw the consolidation of a balance sheet, and we saw the concept when there is no chain. And we also today saw that if there is a chain holding, how does a consolidation take place? The steps remains the same. But in this particular case, a little 3 focus points comes into play. And I also gave you the consolidated P&L also. There was just one question of the study on that. And I gave you that your focus in terms of the NCI share is getting the rectified profits of the subsidiary and getting the share of the NCI. That was a major focus point. And thereafter, we went ahead after this particular part, we went to another section, and that was a changes in ownership interest. We'll look at the concept of changes in the ownership interest, wherein we did 2 cases with you. Wherein I did 2 cases with you in terms of change in ownership when the control is not lost and when the control is lost. And we have seen that if the control is not lost, then it is simply bank to NCI, NCI to bank, and the gain loss enters equity, and there you do a reversal entry of 103. And we've seen in detail the concept of that accumulated OCI. Now, there is something more which is also given in the study material on consolidation, which I didn't touch much, but I just give you a very tip of the inputs, and that is which you can do a little reading on. There is an input given in the study material regarding the concept of investment entity. I gave you some basic inputs, but there is some inputs on the investment entity which tells you that what are the parameters, the definition, and the characteristics of an investment entity. And there is some illustrations which is given. So this is one area which you can go through, though it's never been touched in the exam. So considering the time frame, considering everything, I didn't go into details. I just gave you some basic input of what is an investment entity. But you can go through all this. As far as investment entity is concerned, Index 110 gets completed at this stage. Well, so that is the marathon on Index 110. So I think now moving forward, I guess we're going to get some evening classes. I think you already have the schedule. So mornings, we'll be meeting instead of mornings in the evening. I guess the class, there will be a little break in between. But you can make the best out of this break in between. I know you might have other classes as well. But maybe you can do a little revisions in terms of 103 and 110, a little consolidations and practice a bit. Right, friends. So I think that seems to be good. And thanks, Yadu, for the OCI inputs. You're most welcome. And Shruti, just a request, sir. Yeah, please. The rest classes from 20th evening, if possible, can you spare some time in morning instead of evening? Bahut thand hai. Well, it's not really in my hands. Actually, the schedule is being decided by the Board of Studies. And I think considering there are other subjects which also needs to be scheduled, so I think we're getting slots only in the evening. I am comfortable, in the morning as well as in the evening. But I guess it's something which has already been planned. I fully understand, but I think this is something which needs a lot of considerations, fixing up classes for other subjects as well. Okay, and thanks for the pointers on the OCI. You're most welcome indeed. Right, friends. So I think that's all for the day. And so see you next, I think almost with a little gap. So we're going to see you next. Till then, thank you, all of you. Please revise these standards. If you've got any queries, send it to the ICAI email and we'll definitely address them as well. Thank you, friends, once again, and bye-bye and take care. Enjoy your Sunday.